Hello everyone, this is Gilbert Gelada. I'm talking to you here from CPLSPA downtown Orlando. This is Tufts on Tax, where all your tax questions are answered right here with Mr. T. Scott Tufts. You can call him at 877-647-7887. Again, that number is 877-647-7887. If you're watching YouTube, it's going to be on the banner on the bottom of the screen. And if you're listening, you can also email him at stufts@cplspa.com. That's stufts@cplspa.com. Hello, Scott. How are you today?
Good to be with you.
Good to be with you too. And again, as usual, we're tackling another form.
Yes.
And today it's we come back to S Corporation with Form 7203.
Yes.
If
So
they can see that on the screen, 7203.
Yep.
We'll put it.
So S corps are one of the entities we've talked about that are tax entities. They're not something that you form an S corp at the Secretary of State, for in Florida or whatever state. It's a particular type of tax entity. Mm-hmm. Okay. Now, many of our businesses out there will know what an S corporation is. You make an election and you say, I want to be a corporation under the tax laws. That's a special kind of corporation. That's an S corp that takes its profit and loss each year and passes it through using a K-1 to your individual return. You hand it to your accountant, or you put that information on your tax form using this K-1. That's the general idea, okay? That it's not paying taxes on its own. It's passing it through to you. Now, in our complicated society, that's a very gross generalization, because we're getting much more complicated in our tax laws. We've talked about this, and the S corp is no different. Okay, and the nuances of what entity you are, you have to understand this. You cannot go off and just form an entity. Why? Because let's say you formed a LLC, because someone says don't form a corporation, form an LLC.
And they always recommend that, don't they?
Right, and they recommend an LLC, but an LLC can be, by election, an S corporation for tax purposes.
Oh.
No matter how many members you have. So you can be 100% owned by one person, and they can make an S election of an LLC to have it treated for tax purposes as an S corporation. Okay? So we have to kind of know what we're doing. We can't drive a complicated car and then get in it and say, I don't care, I don't need to worry about this stuff. Now, you can choose to, but that's not the vehicle you're going to want to be in, right?
Or that's not the vehicle you need if that's not
for your needs, right? If so I'm kind of using that analogy to say that you have to get into the details here a little bit to know what you're doing. And S corporations have some rules to them that are the rules of the road, using a driving analogy, that you have to abide by. Okay, so an S corporation, for example, will treat everybody as the same interests pro rata for distributions. What I mean by that, you make X amount of money, you have cash on hand at the end of the year, you have to distribute according to your percentages that you're in, right, of ownership. You cannot give you more and me less, and pick and choose. In other words, you cannot have preferred dividends conceptually in an S corporation, tax-wise. It's meant to be pro rata. Got it? So when we get into these rules under the S corporation, we've got to realize that we got rules of the road for the S corporation, just like we have rules of the road for partnerships. We've been talking about that. And you have rules of the road for C corporations. Got it? So you have to know what you are dealing with when you're in the tax world. So we have to know, when we're business entities, are you a C corp, an S corporation, a partnership for LLC purposes, or a disregarded entity, which means for tax purposes it's as if you don't exist as a separate entity. It goes on the individual owner or other owner, whoever the owner is, on their return.
So what issues that you would face, or actually the clients or individuals face when it comes to Form 7203, that you come to the rescue
Right. So what I come to the rescue on is when someone claims that they have a basis position, a stock basis position that is not in line with maybe the 7203 that their accountant has prepared, or there's some dispute about what makes up the stock basis. And you have to understand that when you're looking at basis, what we're talking about there is you're going to have when you talk about your basis in your interest, right? You put money in to the company, right? You may also have loans that you've advanced to the company, and that may be your debt basis. So you have kind of equity in the company and some debt in the company, and together you're looking at your stock basis that comprises your ability of what you have in. And the reason why that's important is the rules may say that, let's say a loss is appearing on your K1 from the business. The business loses money this year. On the tax form, the K1, it says, we lost money. Here's your share of the loss. Okay? You have to go through and make sure that you have the basis to be able to take that loss. Okay? That's the way it goes. So you cannot assume that it's on the K1. You get it automatically. Got it? There's some steps. And we have some other rules too in the instructions and whatnot. We always look at other things like, and let me just kind of walk you through it. You always have to worry about at-risk limitations, passive activity, and excess business loss limitations. And there are forms with that. Now, passive are those like the way that you group rental activities and so forth. At risk means that you have to be sufficiently liable for the, you have to have, you're standing behind the company, so to speak. So there's all kinds of things that get into losses. So let's kind of go back to the simple situation. If your K1 shows that you have a loss and you're looking to take that on your personal return from a business, an S corporation, you have to take a step back and say, okay, are these limitations going to apply to prevent you from taking that loss on your tax return, on your personal tax return? Got it? So Form 7203 is heading for is a personal return that's done that the IRS has come up with to provide a limitation on losses that you need to see if you have basis to be able to take your loss. Okay? And it's a running total of basically what you have into the entity from the beginning of the year, tracking various things, various items. And that's beyond the scope of talking about them, but the gist of it is you're trying to keep track of what additions and decreases have occurred to your basis during the year, that you come up with the right number. Okay?
So when did this form come out?
2021.
So it's kind of recent.
So the form actually has been revised in December 2022. You can see that under the form 7203.
That's what actually made me ask.
But it's actually come out now, so it's new. And so we're getting out in front of this thing because people are starting to see it and they have questions. Hey, what is this? And unfortunately, Gilbert, we're talking about another form. So as you started, you said, what form are we talking about today? The whole point of, or a lot of what I'm trying to get out there are, people are driven by a soundbite, okay? If you're staring at your Form 7203 and you think the bottom line basis that they've got listed is wrong, now what? Right? Well, it could be a disagreement with you and the numbers that go in it. It could be a disagreement with your preparer. One of the things that I'm noticing is that what the IRS is looking to do is, on part 2 of the form, they have something called shareholder debt basis. And if you look on this part, it says debt 1, debt 2, debt 3, formal note, open account. So in the gathering of data, what the IRS is asking you to reveal in this form is, do you have a formal promissory note on the debt that that what you've advanced to the company? You understand what that's talking about? So this is helping people see that when you claim to loan money to your company, right, instead of capital, right, capital's at risk, right? So let's back up. You and I go into business together.
Mm-hmm.
How much are you putting up?
Let's say 20,000.
Okay, and that's and let's say we're going to be 50-50, and I say I'll match that.
Mm-hmm.
All right, and if business doesn't work out, okay, we've lost that 20,000 each or 40,000. You see that, right? And that was the capital that we put in, that we were willing to get the business going, and off we go.
Mm-hmm.
Now, what happens if you say, I'll put up 20 if you put up 20, right? And I'll loan an additional 20 because we need it, because I don't have any more. I don't have more than 20. Well, we can still go in at 20 each, but then you have this additional loan, right, that you're going to want to get paid back. Now, we're the company now going forward. What are the terms of you getting repaid your 20? You want it as soon as it's available? You want to say, I'll take it in 5 years? I'll take a little bit each year for the next 5 years? What are you going to put on the business to make it pay you back that 20? And should you get paid back that before you and I get anything for our investment, our 20? So these are very practical decisions that you would reach going in on the front end or at any time.
Questions to ask.
Exactly. And you saw in my example where we made a quick decision about money we needed to run the business, but we needed to distinguish between at-risk capital and that which we needed to, let's say we can't get, as a starting business, we can't get the, funds borrowed from a source, but you have the ability to loan. We might be able to position ourselves to maintain that 50-50 position, but get into a situation where you can make an additional loan as long as you're satisfied with the terms of that. Okay? And so if we draw up a formal note, then you would be checking that box here for the type of loan that you have. And you would have what we call debt basis in your stock. Okay? So these are the kinds of things we're getting into, where we're looking at how much money you have in and what's your basis in the business. And you see that? So if you had loaned 40,000 to 20,000, you had put 20,000 of capital in, and loaned another 20, you'd have 40 in. Agreed?
Mm-hmm.
And we already talked about it. I have 20, but we're splitting things 50-50. See how that's going? But you have more at stake. Yes?
Correct.
Yes?
Another 20.
Exactly. And so if a loss came out and we split that loss for the first year, how much should you be able to deduct? Well, this is getting into the idea that you can deduct some losses against that loan that you made, right?
Because my loss is more.
Exactly. So you have more at stake, correct?
Exactly, yeah.
And the theory is that in an S corporation, you should get this debt basis and have the ability to take those losses. Now, we're talking about just that rolling basis, but then one day there might be, hopefully not losses, but gains because of our remarkable efforts, you and I. Yes?
Yes, absolutely.
And we hope to be profitable.
Definitely.
So any business
revenue here.
Exactly. So we want to be successful, and then we want to be able to do the taxes correctly. Agreed?
Totally agree.
All right. So and again, this is the tough thing about taxes. We've
the only tough thing about
the big picture.
Yeah.
You start talking taxes, people gloss over.
I know.
Right? Like you're almost asleep,
Yeah.
So
I'm
what
falling over.
Exactly. Because it's not exciting, but it's a reality of what a civilized society does, and yet we see what we're talking about here is complex, right?
Definitely.
And so, yes, you can hand this to an accountant and say, that's too complicated, Scott. I'm just going to hand it to my accountant. Okay.
But you still have to have an idea.
Exactly. And these forms are becoming more and more data gathering devices by which the IRS can better implement the policy.
But did they feel or see results of helping individuals and companies?
Yeah. So what happened before
issuing this?
Well, so what happened is before they didn't have a form. They had a schedule that people were recommended to provide.
Okay.
As part of their internal paperwork.
But this
now mandates the form that they can identify. They can, find a way to lock these into the data, and then go right to it when they're trying to.
So it did help significantly.
Well, it's going to help the IRS to look at it, but it's also got all kinds of features to it. It's going to help them understand when someone claims to have gotten the stock by gift, inheritance, or purchase. It's going to talk about a running total, and quite frankly, it's going to give them a form that's part of your forms to look for, and then see if they can get the information from that form instead of digging it out over other papers and in audit or whatnot. Okay? So this is happening more and more, where the information that they're gathering is available on a form that they've created. And with the electronics the way they are, can be electronically transmitted, right? And the information gathered. And in my world, it allows me to say, let's say we get into litigation, I could say, let's look at the 7203. You see what I mean? I can go to an accountant and say, what led you to fill out the 7203 the way you did? See that? And we talk the lingo, right? Like your doctors talk lingo, yes. They have difficult words to describe parts of your body, right? Right? My body and everybody. So this is the kind of thing. It's got its own language. We should not be surprised that the tax laws have their own language, and we should not be surprised that there's some form that they use to track information. And that's the gist of the program. I mean, this is what I've been trying to get out there, is that there are forms that are going to be important in litigation that or in situations where someone really needs to pull them, look at them, make sure they're being done properly, or understand what's on them. And that's kind of where that goes. Okay. Yeah. And many times in litigation, let me say this last point. Many times in litigation, you might not be able to get the whole tax form. You might only say, I want the one form, one part. You see what I'm saying?
Yeah.
And so that way you're not digging through someone's entire form, but you might be able to get the 7203. Okay? That's kind of what's starting to unfold with all this.
Well, here our purpose and goal is, like you said earlier, we want to educate people, open their mind, and have some knowledge. I mean, you don't have to go to the nitty gritty and to know like an accountant or a tax lawyer,
right?
But at least know what you're getting involved.
And let's finish this off this way. So as I was describing the note and whatever and all this and basis and all this stuff, think about what this is going to force at tax time. It's going to force your preparer, when they're filling out this form, to ask you, do you have a formal note to protect you, and like the example we gave, your $20,000 position, and force the discussion perhaps to occur where you say, I guess I need a note, or gee, maybe I should have a note, right? As opposed to an open account. An open account means we have an oral understanding. Now, which one would you want? A formal note or an open understanding?
Open understanding.
Okay. You don't want a formal note. Well, how are you going to be protected? If I fall off the planet and nobody I know knows what you say you loaned. And what about the terms?
I see.
We'll pay you one day. We'll pay you back one day. How does that feel? Versus...
I see your point.
Okay. I'm just saying it gets that discussion on the table, and maybe that's at the end of the day it's a good thing.
Yeah.
So, but anyway, that's how I would get involved. Maybe a dispute arises, unfortunately, because the parties realize maybe it was booked that way, but they didn't reach an agreement on it, and it gets them to the table. Got it?
Absolutely.
All
If you folks, if you have any situation similar to this, or you have any questions regarding forms, regarding anything legally, your man is Mr. T. Scott Tufts. You can call him at 877-647-7887. That number is 877-647-7887. And you can email him at stufts@cplspa.com. Again, that's stufts@cplspa.com. And again, if you're watching YouTube and you're not listening on Apple or Google or Anchor or Spotify, you can read it on the banner at the bottom of the screen right here, and you have the email and the phone number. Thank you, and we'll see you next time.